So we will now proceed with the discussion of the financial ratios and the significant points that they are indicating about a certain company's financial strength, profitability, and strategy performance.
Go monkey!
So, financial ratios are mathematical combinations of financial statement accounts. This relationship in the financial statements help the stakeholders, particularly the primary group of the stakeholders, namely the investors, the creditors, and also the management, to identify and understand how well a business is performing, and also identify the areas in the business needing improvement. So, before we elaborate on the financial ratio, let us first have a quick glimpse or a recall of the financial statements, which are the basis of these ratios. So, basically, we've been taught that accounting is the language of business, which communicates to the stakeholders the financial position and financial performance of the businesses. And in order to be able to do that, the accounting has an end product. The product of accounting would be the sets of the financial statements. So there are 5 components of the complete set of the financial statements. The first component would be the statement of financial position. Commonly, this statement of financial position is known as the balance sheet. This is also the old term for the statement of financial position. It presents to the stakeholders the assets. These are the resources owned by the companies. Next would be the liabilities or the obligations that was assumed by the business. And lastly would be the net worth of the business, which was indicated by the equity accounts. Second would be the statement of comprehensive income. The old term for the statement of comprehensive income is the profit or loss. So more commonly, this is known as the income statement. The income statement presents the results of the operation of the business. So in here, we can see the revenue and also the costs and expenses incurred by the business for a particular period. Third, the statement of changes in shareholders or owners' equity. In here, we can see the increase and also the decrease in the residue account, which is the shareholders or the equity account. Next would be the cash flow statement. The cash flow statement presents the major activities of the business. This will be the operating, the investing, and the financing, and also the net amount provided by and also used by these activities during the accounting cycle. Last component of the complete set would be the notes to financial statements. The notes to financial statements help the users in order to understand further the line items presented in the 2 financial statements. So in the balance sheet, again, we can see here the assets, liabilities, and the equity of the business. And in the income statement, we can see here the revenue and the expenses. Later in the discussion of the financial ratios, these accounts will be used in order to compute the ratios. Next. So, financial ratio analysis. Financial ratio analysis is an important tool or useful tool in order to do financial comparison of 2 or more businesses. So direct comparison of business, meaning using relevant amount, will not be efficient because businesses differ in size. So for instance, you cannot say that a company earning 300,000 pesos in a year is better than a company earning 100,000 in the year, because we have to do a relative analysis. If the first company earning 300,000 has an investment or capitalization amount of 1 million, it means that the company earned a 30% return, all right? But for the second company, which has a lower amount, from the 300,000, the second company earns 100,000. Okay, what if the capitalization is 100,000? It means that the rate is 100%. So, based from that example, even if the second company earns a lower absolute amount of 100,000 compared with the 300,000, that second company is performing better than the large company. So, financial ratio will help us to dig into that concept. So, for financial ratios, we can do comparison. The comparison can either be intercompany or intracompany. Under intercompany, we will compare business versus another business. So, other term would be horizontal comparison. For the intra-company comparison, the comparison is within the business. This is also known as the vertical analysis, wherein we will compare the performance of the different periods of the same business. Okay, next. So, this time we will now proceed with the financial ratio computation. The book that was provided by our good professor has an appendix or a listing of the key financial ratios. It is found on page 240 to 241 of the book provided by the book. So you may browse on that. So we will discuss the 5 types of the ratios. First one would be the profitability ratios. The second one would be the liquidity ratios. The third one would be the leverage ratios. Fourth is the activity ratios. And lastly would be the measure of the financial performance. We'll start first with the profitability ratios. From the term itself, profitability ratios will help you assess the ability of the business to earn profit. When you say profit in accounting, it means the difference of the sales or revenue and the corresponding expenses. If you will take a look at an income statement, typical income statement, the first item would be the gross amount. The gross amount is known as sales, alright? Sales if the product is in terms of goods, and revenue if the product is in terms of services, intangible. So, from the sales, the next item would be the cost of sales. So, if you have revenue, it will be the cost of revenue. When you say cost of revenue, and you will have to differentiate that with the operating expenses, cost of sales or cost of revenue are direct expenses. It means these expenses are directly attributable to the product of the business. So usually, the composition of the cost of sales would be the direct materials, direct labor, and the factory overhead. So if you get the difference of the sales minus the cost of sales, the result is gross profit. In accounting, our term is gross income. So when you see the word income, okay, please do not be confused. Income is the net amount. It is the profit, all right, not the revenue or the sales. So again, sales minus cost of sales, you have the gross profit. From the gross profit, all right, we will deduct the additional expenses needed by the business. We stated a while ago that for the cost of sales, we are pertaining to the cost of production, the cost of factory. Other costs such as costs in the offices, in the administration of the business, general expenses will not be included here, but instead will belong here, all right, operating expenses. So, guys, again, okay, clarification lamang, for the expenses of the company, it is a must that you have to identify the proper classification of the expense. If the expense is directly related to the product, that is the expense in the production in the factory, okay, it will be included in the cost of sales. Next, if the expense is not related to the factory, but is being incurred by the business, example, the expenses related in the offices, okay, this expenses will form part of the operating expenses. From the gross profit, this one, we will deduct the operating expenses and we will get the operating profit. Okay, other term of the operating profit, FYI, is EBIT. Okay, in management subject, it is EBIT. When you say EBIT, it's earnings before interest expense and tax expense. So, again, OP, operating profit, means EBIT. Okay? It is sales minus cost of sales minus operating expenses, but, okay, not deducting yet the interest and the tax. Okay? From the EBIT, we will deduct the interest expense and the taxes. We will come up with the EET, earnings after tax. Okay? In some books, the term is net profit. So, what is the importance of discussing this one? Okay? The first type of profitability ratio would be margin ratios. Next time class, next time guys, that you will next time that you will hear the word margin ratio. Okay? Take note, when you say margin, we are getting the relationship of your sales with the profit. Alright? So there are various different kinds of margin ratio. You have gross profit margin, operating profit margin, and net profit margin. As you can see, the common denominator is profit margin. So the difference lies only on the term. For the first one, it's the gross profit margin. Therefore, it is the relationship of the gross profit over the sales. So the formula would be simply gross profit over sales. Again, gross profit, it's the difference of sales minus cost of sales. Next, okay, operating profit margin. It means it is the relationship between the operating profit and sales or revenue. So the numerator this time shall be further deducted with the operating expense to get the OP. Sometimes the term used in the financial statement would be earnings before interest and taxes. Sometimes the term would be operating income. So they all pertains to the same term. It will be operating profit. And lastly would be net profit margin. So we will use the net income, compare it or relate it with the sales, and we'll come up with the net profit margin. So you don't have to memorize. For as long as you see the term margin ratio, it means you are getting the percentage of the profit over the sales. So the higher the percentage is, the better is the profitability of the company. Okay, and lastly, last note. Okay, take note that for the profitability ratio, we are using only the income statement. So the difference between the balance sheet and the income statement, the balance sheet presents the financial position, financial strength of the business, while the income statement presents the result of the operation. So if you are after the profit, do not look at the income, do not look at the balance sheet, but instead, okay, just consider the income statement because it is in the income statement wherein you can find the sales, okay, the cost of sales, and the operating expenses. Any clarification before we proceed?
Here.
Okay, sige, next
Ma'am,
slide.
sorry. Where
Yes.
do you deduct the depreciation?
For the depreciation, guys, alright, we have two, okay, allocation. The depreciation related to the factory, to the production will form part in the cost of sales, while the depreciation for the computers or equipments used in the office, in the administrative function will be part of the operating expenses. So depreciation, it's a combination of the cost of sales and the operating expenses. What you have to remember is that for the cost of sales, it is related to the factory, to the main operation. For this one, these are ancillary or additional expenses, not really needed to produce the product, but it's needed in order for the company to continue operating. That's why it's called operating expenses. Okay, question before we proceed? Sige. Next. Okay. After the margin ratio, we'll have the second type of ratio under profitability ratio, and that will be return ratio. If margin is a percentage of profit over sales, return, okay, pertains to the relationship of the net profit, that is the return. When you say return in accounting, we are pertaining to the return on capital, meaning the return on your invested capital. How much is the income or the net profit gained because of the invested capital? So, return ratio again is the relationship of the net profit over the items. Alright, so we have several items for returns. You have net return on sales. So, that will be net profit over sales. Next, net return on total asset. It will be net profit over total assets. Next, return on shareholders' equity. It will be net profit over SHE, okay, over total shareholders' equity. And return on invested capital, take note, alright, for accounting or finance, when you say capital, it means the sum of all, okay, long-term liabilities and equity. Again, when you say capital in finance, we are pertaining to the investment, the capitalization amount. Okay, the capitalization amount is divided into two. The investment from the creditors, we call that long-term investments or long-term liabilities, and also the investments of the stockholders. We call that equity. So, to get the return on invested capital, it will simply be net profit over the sum of the long-term liabilities and the equity. Or simply, alright, the net profit over the capital. Okay, under this ratio, for the analysis, the higher the profitability ratio for the return ratio, the better is the performance of the company. So far we have two types of main ratio under profitability. We have margin ratio. How do you compute the margin ratio? Simply, it is profit over sales. Right? The term will depend on the kind of profit. It can be gross profit, operating profit, or net profit. Okay? Return ratio. For the return ratio, okay, it pertains to the net income. So therefore, it is the percentage, okay, of net income over the sales, the total assets, the total equity, or the total of the long-term liabilities and equity. Question before we proceed? Sige, next, please. Okay, last kind of the profitability ratio would be the earnings per share. From the term itself, all right, it's earnings per share. When you say earnings in accounting, you are pertaining to the net income. So, net income per share. When you say share, it is the proof of ownership in a corporation. When you own one stock, it means you are an owner of the corporation. So, the proof of ownership is the outstanding shares. So, to get the earnings per share for your investment, simply determine the earnings per share. It is determined by getting the quotient of the net profit over the total number of outstanding shares. Not the authorized, but the outstanding shares. Alright, outstanding shares. Question before we proceed. Sige, next tayo. Okay, so we're done with the first kind of ratio, profitability ratio. Again, profitability ratio tells you the performance, okay, the ability of the company to earn profit. This time we have liquidity ratio. In accounting, when you say liquidity, okay, it actually means the ability of your current assets to be converted faster into cash and therefore be able to pay your short-term obligations. Again, liquidity, okay, if the company is liquid, it means that the company have enough current asset, okay, dapat it must be in the form of cash in order to form its current liabilities. So, for the liquidity ratio, we can use current ratio and working capital. So, for the current ratio, it's simply the quotient of your total current assets over your total current liabilities. If your total current assets is 1 million and your total current liabilities is 100,000, it means that your current ratio is 1 million over 100,000, that would be 10. So you have 10 pesos to pay for every 1 peso of your short-term liability. So your business is liquid, okay? The current creditors will be confident in lending you amount because you have the cash to pay for your short-term liabilities. Next, working capital. Same example. You have 1 million cash, 1 million total current assets, and you have 100,000 current liabilities. If this one is ratio, okay, for the working capital, it is an absolute amount. So the difference of the total current assets na 1 million, you will get the difference of 1 million from the 100,000 short-term liabilities. So the result is 900,000. So your working capital is 900,000. You have the exact amount of 900,000 to pay your liabilities. Between the two, okay, the better measure is the current ratio. Why? Because the current ratio, okay, observe the relativity rule. The same example a while ago, okay, if you will use peso amount in comparing, it is not logical. Why? Because okay, the result may have a bias based on the size of the business. Of course, if the business is really large, syempre, for the working capital, you expect really a higher amount. But if you will use current ratio, you can really compare large and small companies because the basis is relative, meaning in terms of percentage or ratio. So for this one, the higher the current ratio and the working capital is, the higher would be the liquidity ability of the business. So same as profitability, okay, the way to assess liquidity ratio would be the higher the amount, the better for this one. Sige, next tayo. Okay. Next, leverage ratio. A while ago, class, guys, dun sa, sorry, a while ago, alright, so, we've discussed about liquidity. We said that liquidity pertains to the ability of the business to pay for its current obligation. For the leverage ratio, our concern would be for the long-term, okay? Long-term liabilities. How is the position of your total liabilities with your total assets and also total equity? For this one, okay, the lower the amount is the better. Because Okay, it is not good for the company to have many liabilities. Alright, so if you'll be asked to compare two leverage ratios, since it pertains to the amount of liability over the asset or the equity, the lower the leverage ratio is, the better. We do not want debt. Okay, we want income. We want assets, investments, but not debt. Therefore, for this one, the lower the amount is, the better. Alright? And for this one, we will not use income statement. What we will use would be the balance sheet, because we are looking at the financial position of the company. So you will use the asset, liability, and the equity. Next. Okay. Last type of your leverage ratio would be the times interest earned or coverage ratio. This is important to determine, especially if the company is having borrowings from banks and other financing institutions. So for this one, okay, under the numerator, you will use as basis the operating profit. Again, sabi kanina, operating profit is actually your EBIT. It's the earnings before interest and taxes. So the EBIT, divide that by the interest expenses, you get the ratio. For this one, the higher the ratio is, the better. Because the times interest earned or coverage ratio tells you, okay, how much does the company have in order to pay for its interest expenses. What are interest expenses? These are the cost of your long-term debt. Okay, so if you will borrow money, it will have corresponding cost. The name of the cost is interest expense. Same is true with stocks, okay? If you will issue stocks, it will also have a corresponding cost for the company. The name is dividend expense. So for this one, since we are after the debt for leverage ratio, we have to see, okay, the capability or ability of the business to pay for its cost of financing. So the proper ratio for that one would be the coverage ratio. All right, next. All right, this time we'll proceed with the activity ratios. So far, let's recall how many ratios have we discussed. The first one, profitability ratio. Okay, a focus mo doon would be the income statement. Okay, next would be the liquidity ratio. Okay, so the focus would be on the balance sheet, more particularly the current assets and the current liabilities. Okay, next, the leverage. Okay, for leverage, it will be non-current. Okay, activity ratios. From the term itself, our focus is on the activity, the operation of the business. It measures how efficient the business operation is. So, how can you measure the efficiency of the business operation? Okay, you can use number 1 and number 3. Okay, number 1 and number 3, days of inventory and the average collection period. It tells you, okay, how many days or how the company utilize its inventory, okay, by being able to sell it to the customers, how many days before the inventory are being sold. And also how many days before the sold inventory, okay, under receivable, we're able to collect. So number of days of the inventory, number of days of the receivable. The lower the number of days of inventory and average collection period is, the better. It means you are efficient if, okay, you only have 10 days before your inventory will be sold to the customers compared with 100 days. Because 100 days for the inventory would mean 100 days of storage for the said inventory. Okay? For this one, average collection period, it is not enough for you to send on account. It should be on cash sales. So, for the average collection period, our concern is the number of days that we convert receivable into cash. Remember, liquidity is very important. Liquidity, the focus is cash. Okay? So, for business, the cash is the king of finance. So, without cash, the business will not be able to operate. So, this one is really also important. Alright, last, inventory turnover. How do you compute the inventory turnover? Cost of goods sold over inventory. It tells you how many times the inventory will be sold during the accounting cycle. So if your answer for this one is example 200, it means, okay, you were able to sell, to use your investment 200 times to have a sale, right? Corresponding to 200 transactions. The higher the inventory turnover is, the better. So for 1 and 3, the lower, the better. For number 2, okay, the higher, the better. Bakit the higher, the better? Because it tells you how many transactions of inventory sales can the company have. Okay, for number 2. Medyo gets ba yun for this one? Alright, next. Okay, for this one, we will now measure the financial performance. Okay, so a while ago, we're focused on the financial position of the company, right? Financial position meaning the balance sheet. This time, we will try to relate the financial position with the profitability. And how do you measure that? We can use the 5 ratio. Let's just read the formula. Anyway, the name of the ratio is already self-explanatory for the formula. First one, dividend yield on common stock. Okay? To compute for the yield, okay, simply get the quotient of the annual dividends per share over the current market price per share. If you remember the coverage ratio, sabi natin, it is the cost of borrowing. Okay, this one is the cost of issuing stocks. If we have interest expense to pay for our creditors, we also have the dividends to pay for our stockholders. So this is also another measure. Alright? The higher the ratio, the better. Kasi it will mean a strong investment for the investor. Number 2, price-earning ratio. The price over the earning. The current market price or value of the share over the earnings per share, which we computed under the profitability ratio, EPS, alright? Anong si EPS? Net income or earnings over the total number of shares outstanding. Okay, dividend payout. So dividend payout is basically your annual dividend per share over your earnings per share. Internal cash flow, alright, it is after-tax profits plus depreciation. Plus, guys, bakit may plus depreciation? Okay, we are after the cash flow. Take note, net income is the difference of your sales or revenue and all your expenses. Not all expenses are in the form of cash. Best example of non-cash expense would be depreciation. Diba? How do you incur depreciation? Not because you are paying for the depreciation, but because you are allocating an amount of the capital and treating it as part of your expense. So, if you're asked to compute for your internal cash flow, okay, the formula is simply add back the depreciation from the earnings after tax. This will be the amount of your cash available for usage in the company's operation. Lastly, free cash flow. Okay? For the free cash flow, we will just expand number 4. After tax profit plus depreciation minus capital expenditure and minus dividends. Why? Okay? For the free cash flow, we are appropriating an amount of your cash that is not available for current operation. Ano yung hindi available for current operation? The cash that will be used for future investment, capital expenditure, and also the cash that is needed to pay for your stockholders. So, that will be all for the financial ratios. Wala bang questions?
Yay!